Every major corporation essentially lives two financial lives at exactly the same time. Every single dollar flowing into a business drops into a system and immediately splits into two divergent sets of accounting rules. The first pipeline generates the GAAP financial statements. Here, the guiding logic is the matching principle. The goal is to accurately reflect economic reality for investors by pairing revenues with the expenses incurred to generate them, regardless of when cash changes hands. The second pipeline builds the IRS tax return. This ledger is driven strictly by statutory laws drafted by Congress. Its primary function is to accelerate and mandate revenue collection for the government. Because these two systems serve entirely different masters, they treat the exact same business transactions differently over time. An expense recognized today on the financial statement might not be deductible on the tax return for years. This creates a structural divergence. Since the two frameworks calculate income using different axioms, the pre-tax accounting income shown to investors almost never equals the taxable income reported to the IRS. If a company simply took its actual IRS tax bill and slapped it onto the GAAP income statement, the mismatch between recognized revenues and tax burdens would paint a highly distorted picture of the company's true economic standing. We need an accounting intervention to fix it. That intervention is a mandatory accounting framework known as inter-period tax allocation. This is the mechanism used to bridge the mathematical gap between the financial ledger and the tax ledger. The core rule of this framework is straightforward. A tax expense or tax benefit must be recognized in the same period as the related financial income or expense. It forces the tax impact to match the GAAP timeline, regardless of when the IRS actually demands the cash. To make this timing adjustment work on the balance sheet, accountants use two specific items: deferred tax liabilities, or DTLs, and deferred tax assets, known as DTAs. This means we have to separate our taxes into two components. First, there is the current tax expense, the cold, hard cash actually payable to the IRS this year based on the tax code. Second, there is the deferred tax expense, which calculates the expected future tax consequences of the actions we took this year. DTLs and DTAs operate essentially as temporal shock absorbers. They capture the discrepancies between GAAP and the IRS, allowing us to assign the tax impact to the correct economic period without violating any tax laws. Before we can build those deferred tax positions, we have to filter out the noise. We must clear the ledger of any events that will never reconcile between the two systems, no matter how much time passes. We call these permanent differences. These are items of income or expense that are recognized in either pre-tax financial income or taxable income, but absolutely never in both. Take a look at this financial table. Notice the line for interest earned on municipal bonds, totaling $600,000. Under GAAP rules, that bond interest is fully recognized as income. It actively boosts the pre-tax accounting income presented to shareholders. But the IRS treats this differently. By statutory law, municipal bond interest is explicitly tax-exempt. It is entirely excluded from taxable income, and the IRS will never collect a cent on it. The reverse happens with government fines or penalties. A regulatory fine reduces GAAP financial income immediately as an expense, but the tax code explicitly bars you from ever deducting illegal behavior to lower your tax bill. Because permanent differences never reverse over time, they alter the company's current effective tax rate, but they generate absolutely zero deferred tax consequences. When calculating DTLs and DTAs, we simply ignore them. Once the permanent differences are cleared, we focus strictly on temporary differences. These are items of income and expense that both systems agree on, but choose to recognize in entirely different accounting periods. This cable outlines the MAC-ARS depreciation rates. Accelerated depreciation is the most common trigger for a deferred tax liability. Here is how that plays out for a $100,000 machine. Under GAAP, you might use a steady 5-year straight-line depreciation to match the equipment's useful life. The IRS, however, allows an aggressive 3-year MAC-ARS schedule to spur investment. Look at the delta in year 1. The IRS allows a drastically larger expense deduction immediately. This severely shrinks your taxable income, lowering the actual cash you must pay the government today. But the total cost of the machine hasn't changed. Accelerating the deductions under the tax code guarantees fewer deductions available in later years. The math inevitably flips in years 4 and 5, where GAAP continues to record an expense, but the tax deduction drops to zero. To calculate the DTL, you take that future taxable amount, the delayed income we will eventually have to pay taxes on, and multiply it by the enacted tax rate. A deferred tax liability isn't free cash. Delaying the tax burden today locks in a mathematical certainty of higher future tax payments. So what happens when the situation is flipped? What if the IRS demands tax payments before GAAP even recognizes the corresponding income? This occurs frequently with unearned revenue, like a business receiving subscription fees or rent payments months in advance. From the IRS perspective, cash is cash. When you receive that rent in advance, it is generally taxable immediately, resulting in a higher cash tax bill for the current year. GAAP views it entirely differently. Because the service hasn't been provided yet, that cash is recorded as a liability. It only trickles onto the financial income statement slowly as the revenue is actually earned. Warranty liabilities follow the exact same logic. GAAP forces a company to estimate and expense future warranty costs at the time of a sale. The IRS refuses to allow that deduction until the cash is actually spent on repairs years later. To quantify this, we calculate the deferred tax asset. We take the future deductible amount and multiply it by the enacted tax rate. Paying taxes on income before it is technically earned creates a measurable future economic benefit. That deferred tax asset acts as a shield, protecting later revenues from taxation when GAAP finally recognizes them. With our timing differences mapped out, the final objective is to calculate the single composite income tax expense number that will actually appear on the GAAP income statement. This equation on screen shows how it comes together. Total income tax expense equals the current tax payable plus the net change in our deferred tax amounts over the year. Let's test this equation using this Lucas Company dataset. First, we calculate the current tax payable. $1 million in taxable income multiplied by the 40% enacted tax rate gives us $400,000 payable today. Next, we isolate the deferred component by looking at the balance sheet changes. The DTL balance increased by $10,000, moving from $13,000 to $23,000. Meanwhile, the DTA balance increased by $8,000. Netting the $10,000 liability increase against the $8,000 asset increase yields a net $2,000 increase in deferred tax expense for the period. We bring the current and deferred components together to execute the final corporate journal entry. On the credit side, the actual $400,000 owed to the IRS is credited to income tax payable. The $10,000 increase in future tax burdens is credited to the deferred tax liability. Moving to the asset side, the $8,000 increase in future tax benefits is debited to the deferred tax asset. To balance the entry, total income tax expense is debited for $402,000. By capturing both the immediate tax bill and the delayed consequences of this year's actions, the income statement presents an accurate assessment of the company's financial burdens, perfectly reconciling GAAP's economic reality with the rigid demands of the IRS.